Nobody wants to own treasuries here at 4 or 5%. Literally zero people are talking about it. But I'm old enough to remember in 2020 when the treasuries were uh, wildly high, interest rates were basically zero on a 10-year note. I think it was like 0.3%.
Yeah.
And everybody was shoveling their money into treasuries to earn nothing, maybe just get their money back if they're lucky. So I don't know. It doesn't make sense. Humans don't always make sense.
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Welcome to the Bull of Wall Street. This is episode number 37. We are pleased and honored to have Carley Garner join us. Carley is the co-founder of DeCarley Trading. She's been featured often on Jim Cramer's Mad Money show, Off the Charts, and on Bloomberg, and I'm sure many other places. The Cow Guy. I don't know, Carley. You've been all over with regard to charts, and so Carley's expertise is charts, commodities, futures, options. Did I miss anything? Risk management.
Yeah, you're right. Actually, I like to say I'm actually in the risk management business. That's primarily what we're doing. Even when we're speculating, we end up managing risk most of the time. It's these especially in 2025. It's been an incredibly, I'll just say, interesting year for commodities.
So, Carley, if you could maybe kind of start us off with your journey. I know you live there in Las Vegas. Your firm's there, and Wealth Consulting Group is based in Las Vegas. But you went to UNLV. I think you're a magna cum laude and a double major in accounting and finance.
That is all correct. I kind of took the scenic route in college. I wasn't sure, it took me a while to figure out what I wanted to do. So by the age of 25, I had finally graduated with 2 separate degrees, and I chose finance as the one to pursue. And honestly, everything just kind of fell into place. I didn't plan to get into commodities. It just happened to be that there was an office here in town, and it seemed interesting. So I stumbled in, and I've been doing it ever since. And I have some days I regret it, but in the big picture, I have no regrets. It's an exciting industry. It is a very stressful industry. There's no easy money in any of this stuff. We all know that. But I love what I do. I get up every day kind of excited to see what's going on because they move quickly, and it's not boring. That's what I love about it. It's not boring.
Yeah, well, I'm not looking as much as commodities, but we do. I mean, we manage money for clients, and that's usually going to be in the form of mutual funds and ETFs and individual stocks. But we have to know what's going on with currencies and commodities, and so I look at the charts too, but probably not near as much as you do. So tell me what are you thinking? I mean, it's been kind of a wild year. We had this big drawdown, and we're back up, and it's feeling in some ways a little bit frothy, but some companies are doing extremely well with profitability. Other companies are still struggling, and I feel like it's kind of a tale of two markets, right? There's the companies that are struggling with higher rates and maybe some inflation or tariffs, and then other companies that are just off to the races. What do you think?
Yeah, no, I think you're exactly right. We kind of have two stories going on here, and when you look at the S&P or the Nasdaq, everything looks rosy, but we're only talking about 5 to 10 stocks, running those indices. If you look at the big picture, it's a whole different story. So, as a futures broker, what I do is we do speculate in the stock market, so S&P and occasionally NASDAQ, but mostly S&P 500. We generally use options, but sometimes we're using futures. So today we actually put on a bearish option spread. Now, this can be used as a portfolio hedge or a speculation trade. So for those of our clients that have exposure to stocks. Let's say that they have, I'm just going to kind of round and ballpark things here.
Sure.
But let's say somebody has roughly $350,000 worth of S&P 500 stock. They can use the E-mini S&P 500 futures to hedge that. So they could sell a futures outright and it just kind of locks their price in. All the while they're still getting the dividends and they still are getting the benefit of not selling and triggering a tax event and that sort of thing. So they can completely lock in their price and just remove the downside risk, but they're also removing the upside potential. We generally don't advise people to do that aggressive of a hedge, but what we do instead is use options. For example, today what we were doing was we're selling December 6,900 calls. And this isn't a recommendation. I'm just educational
Sure.
purposes.
Yeah. No, we love it.
So you can sell a December 6,900 call and use the money that you collect for that to buy a 6,000, 5,700 put spread. So this isn't an aggressive hedge, but it's just a way to protect yourself from 6,000 to 5,700 should there be a pullback. If there's not a pullback, as long as we stay below 6,900, it's no harm, no foul. Your hedge just kind of expires worthless. So it's a way for a small amount of protection. At times, we get a little more aggressive than that, and we will sell a call and just buy a put outright, as opposed to doing a put spread. And the difference is, if you're doing it that way, it's called a risk reversal, and you're basically, in the most simplest form, you're purchasing insurance. You're purchasing a put option in which will pay out below the strike price 100%, and you're using the market's money to do it. And again, the downside of that, or the catch, so to say, is your portfolio can't appreciate above the short call strike price. Otherwise, you're losing in your futures account, you're making in your stock account, which isn't the worst thing in the world. If the S&P goes above 6,900 and you're giving up a little bit of upside, I don't think that's a bad deal. So we do those sorts of things to help our clients manage their portfolio risk. Some might say it would be easier just to trim your portfolio or reallocate, and that's, to each their own. Everybody has a different circumstance, and taxes matter, so you have to pay attention to those sorts of things. But that's what we do.
It's super interesting, and I've noticed we have some friends that have strategies that we talk to that are buffered strategies. They're probably going to be in some ways similar to what you're doing, and we even have a person on our trading team that's built these strategies. I am not super familiar with all of those. I know the zero cost collar and things like that, but I know there's cap and cushion and ways to kind of limit downside. Feel like there's been more interest in those, and I don't know if that's just demographics with baby boomers, but a lot of money's gone into these hedged equity type strategies, and there's ETFs now that do this. What do you think?
I'm kind of on the fence. I can't speak for them individually because there's a lot of different things going on, but there's a couple things come to mind that sometimes we forget is this industry, the financial industry, is a business. And when they are in the business of creating products and attracting capital to generate fees. And so we have to always understand that we're always being sold. And I'm not, I'm a person that's selling these services. So I'm on the other side, but I'm just, everybody needs to keep that in mind when we're doing this. And ETF, and the reason I bring that up is ETFs. There's a lot of really great ETFs, and there's a lot of ETFs that are inefficient, especially on the commodity side. I know it's kind of a different topic, but a lot of people think if they want to be long crude oil or natural gas, they could just buy the ETF. And it's true, they can do that, but it's not very efficient. In some cases, you see natural gas rally $2 and their ETF just kind of struggle and tread water. So it's not the best approach, in my opinion, usually. I also worry about people participating in such strategies, not necessarily the ones you're talking about, but for example, like triple leverage ETFs and those sorts of things. And I think a lot of people that are putting money in there, it's probably been working very well for them. But I think there's a lot of misunderstanding of the risks. I think there's a lot of complacency built into this market. And if we do happen to go through a period of deleveraging, which I think, I can't see the future. Maybe we are lucky and we kind of avoid that. But if we do ever go through the deleveraging process, I think it's going to be really, really ugly. And ETFs, even the collar strategies are probably going to have a rough time handling that type of volatility. Liquidity dries up fast, dries up. I'm sorry, risk comes fast. So when those sorts of things, it unfolds quickly. Not unlike what we saw in April. I think that was um, kind of a mini deleveraging event. Luckily, we came right back, and so most people didn't really feel the pain for too long. But the next time around, we might not be so lucky.
That's all really, really interesting what you're saying there. And I don't know, I just think about my career looking back, and I'm kind of a student of the markets in terms of like history and how have things changed. I feel like we are kind of in this crux where the markets are faster, the whipsaws can be bigger. I remember, gosh, I don't know exact date, but like the first term that flash crash came out and people started talking about that and ETFs and
Yeah.
I mean, is that, do you think
May
that's just
2010.
May 2010? So you know this way better than I do. Is this
there.
you remember all this? And so do you feel like it's getting more fast paced and is it market structure? Is it how there's algorithms?
Yeah.
What do you think?
It is faster. It's more. Well, I mean, you and me both survived the financial crisis, so I've actually seen much worse than what we've been subjected to here.
Yeah.
But this volatility comes so much quicker that it's
Yeah.
really hard to fathom. I think it's a combination of things. I think the electronic markets and the algos is a big part of it. I also think it's kind of what I mentioned before, people not understanding the strategies they're participating in, because there's some things that have worked in the last handful of years, like almost like, I don't want to say printing money, but they just have worked because we're in such an abnormally strong bull market that there's been very little pain, to get those strategies to work. And what I'm talking about, for example, is I talk to a lot of retail traders who have gotten in the habit of selling puts of the S&P, and they haven't had to feel really much pain. They had in April maybe a little bit of a struggle, but it came and went so fast that I don't think they even had time to soak all that in. And I think a lot of them ended up coming out the other side just fine. So I think there's a lot of premium collectors that really are vulnerable to getting caught in the wrong side of the spin cycle if something does happen. So I think it's partly just complacency and not understanding the risks in addition to the electronic markets. But also, I'll say one last thing. Since the COVID, the pandemic, the government shutdown, whatever you want to call it, so much money came into the system. There's so much cash sloshing around that everything is just bigger and better on both sides of the trade. And I think it's going to take a few years to wash out all of that money supply and get things to maybe a more manageable level. But the jury's still out whether we actually ever get there, because if something that we're not even talking about today comes around the corner and sneaks up on us, there's no guarantee that our politicians aren't going to do the same thing and, just stimulate the heck out of everything until we stabilize it and then deal with the consequences later. That's kind of been the pattern since the financial crisis. So, the jury's out. All I can say is be very mindful of your risk. At this particular juncture in the S&P 500, I don't think anyone's going to argue that it's overvalued. Warren Buffett is still the GOAT. I know he gets a lot of flack because he's not as aggressive as some of the tech guys, but he has an indicator that basically takes the GDP versus the entire stock market. And if you look at that, it's trading basically two standard deviations from the mean, meaning it's wildly overstretched. It's more overstretched now than it has ever before. And I take that serious. When I see that, maybe it doesn't happen next month, maybe it happens next year or the year after, but at some point, probably a really good chance that there's going to be a better place to be aggressively long the stock market than these levels.
Interesting. That's so interesting. Well, and what you mentioned a little bit ago about premium collection, it made me think of those short vol trades and how people were like making all this money every month. Like I think it was like 8% a month was the roll yield on like short VIX type of things. So yeah, I worry about that too with the complacency when there's more of that. And like you said, the products, sometimes it's the products. Do you think some of it has to do with just a lot of money getting invested indiscriminately, going into indexes, and it just keeps going?
Right. I do think I mean, there's lots of reasons for it, but I do think a lot of it is just simply that there's just so much money that was pumped into the economy in the last 5 years that it's looking for a home. And so we're seeing these things, that it's showing up in everything. We're seeing it in gold, we're seeing it in Bitcoin, real estate, even car prices. It's inflationary. When you have too much money chasing too few assets, it's inflationary. And I think that's the big story on a lot of these markets. I know, like you and I and everybody else wants to talk about fundamentals and why things are happening, but sometimes the simple explanation is actually the correct explanation, which is there's just a lot of money out there and it's got to go somewhere.
Yeah. Well, $7 trillion, I think, in money market funds. That's not counting all the money in treasuries. And so there's several more $1 trillion. Some people would look at that and say, well, that's kind of scary. Those people are scared. They're going to wait. And other people look at that as bullish. We sometimes would view that as a bullish thing, that money could be invested. Right. I mean, how do you view it, or are you kind of neutral on it?
I really appreciate that question. I'm glad that you brought that up because I've been thinking about this recently. And I think the consensus is probably that money will make its way into the markets. And so that's going to keep us afloat. And that very well could be true. We might get some sort of melt up as that money comes in. But what I'm wondering is, and again, I talk to a lot of retail traders, so I'm kind of got a good idea of what they're thinking. And there are a lot of retail traders participating in sophisticated strategies that I think they understand on the surface, but I don't think they understand what could go wrong completely. And here's where I'm going with that. There are a lot of YouTube videos and TikTok videos out there, and honestly, it's a good strategy, but only if you understand the risks and how quickly things can move. And so here's what I'm talking about.
Yeah,
there are people that are sitting money in money market accounts because money market's paying more now than it has in roughly 20 years.
Yeah,
so they're earning that interest, but instead of just being happy with that, they're going out and buying futures contracts, maybe in gold, maybe in the S&P 500, so that they can get the price appreciation of some of these risk assets, or maybe even risk off assets, in addition to the yield that they're earning on the money market. So hear me out. If you have, let's say you have 350,000 in the money market and you're earning 4% interest, you can go into a futures account with about 25, 30,000 and buy one futures contract. And that way you get the best of both worlds. You're earning the yield, you're getting the price appreciation on the S&P. And that sort of thing has worked like magic last handful of years. If it ever stops working, it's going to be an ugly, cycle of margin calls and panic, and you're probably going to make a bad decision because it's gonna be a little scarier doing it that way as opposed to just holding SPX or SPY. So it's going to be interesting to see how these things play out. But just because it's in a money market, I'm not convinced that it's not necessarily exposed somewhere else.
Yeah, that's a good point. Well, I mean, a lot of the CTAs and anyone really who's doing futures, they will hold that money in cash. So I guess that something to be aware of, right? Maybe not worried, but like maybe a little bit worried.
Well, and I don't know. Yeah, it's a little worrisome, but for my mindset, it's more of, I'm not sure that cash on the sidelines is actually going to.
It's not just all dry powder.
Yeah, exactly.
And that's leverage too. Isn't that also leverage in the system? And so like if we, like you said, if we have a delevering,
yes.
So we could see an unwind.
Yeah, you're exactly right. You can imagine if you were someone doing that, and first you start out with no leverage, right? You've got 350,000 earning interest. You're only doing one S&P futures. So there's really no leverage and it washes out. But let's say you get something like April and you think, well, I'll just buy two futures. I'll kind of dollar cost average and then maybe it cascades. I'm not saying this is going to happen. I'm just saying a lot of crazy things could happen when markets start moving quickly.
That's true. So that makes me think of one of the questions I wanted to ask you. You've looked at so many different charts, commodities. What's the craziest thing that you've seen
Well,
in a chart?
I mean, I've seen some really crazy things, and just when I think I've seen it all, something even crazier happens. So I don't know if I can pinpoint one, but I will throw 2020 when crude oil experienced technically we went negative on the front month. That
Negative.
was only,
Yeah.
yeah, it's a little bit of fake news. Like we talk about it a lot, but it was just the front month that did it. It was only a handful of brokerages that allowed trading in that contract. And it was only a handful of trades that actually occurred. But even so, that's pretty wild. Like we went, at one point, I think it was down like negative below zero, 46, 45 or $46. So I'd say that's probably the craziest. Luckily, like we run a boutique brokerage shop. Luckily, we had turned our platforms off to the front month contract and forced everyone to trade the back months if they were going to trade it. So we didn't have people trying to buy, but I know at a lot of brokerages, this is something we'd never experienced. And so what was going on is people were seeing crude oil trading at $5, $4, then $1. And in their mind, they thought they could only lose $1. If they bought crude oil at $1, it's only going to go to zero. It can't go below zero. That's what the mindset was. And so a lot of people hit the buy button. And if their brokerage had that contract still turned on for trading, not only did they lose more than $1, they probably lost 20, 30, 40,000. So that was wild. Yeah.
A lot more. Well, and that's how futures work, right? So whether it's negative or positive, like, I mean, it, can work. I thought of that. I also thought of the periods where in Europe and Japan, you had negative interest rates. I mean, I feel like some of these things aren't theoretically supposed to happen, but they still happen.
You're right. They shouldn't have. The thing is, markets don't always make sense. And that's because markets are driven by humans and humans are emotional. We are very emotional creatures. And when things start looking weird, we do dumb things. That's really the honest truth. One thing I've been talking about recently is the treasury market today is yielding, depending on the part of the curve, let's just say anywhere from 4 to 5%, relatively low risk. If you hold to expiration, you're going to get your money back unless something really crazy happens, which probably isn't going to happen, but maybe it does. Nobody wants to own treasuries here at 4 or 5%. Literally zero people are talking about it. But I'm old enough to remember in 2020 when the treasuries were wildly high, interest rates were basically zero on a 10-year note. I think it was like 0.3%.
Yeah.
And everybody was shoveling their money into treasuries to earn nothing, maybe just get their money back if they're lucky. So I don't know. It doesn't make sense. Humans don't always make sense.
Well, that just makes me think of all those banks that loaded up and they thought, there's no credit risk. So we're just going to load up. And then like, lo and behold, Fed raises rates by a lot. And, you had Silicon Valley Bank and First Republic.
Yeah, the capital losses on those are wild, are massive. As somebody that I'm obscenely long treasuries here, more than most people should be. Like I've gone almost all treasuries. I'm very, very little stocks. This is not a recommendation. Zero people that are listening should do that.
Sure.
My situation's different. First of all, I'm in a business that thrives when the economy is great. So but when the economy goes south, my business just goes south right along with it.
Yeah.
So I've kind of learned through the cycles, like I have to have my powder dry because when the recession comes or the stock market correction comes, I'm not going to have extra cash to put in while everybody else does. So I play things a little bit different. It took me a while to learn that lesson because I remember in the financial crisis, I went in basically, 100% stocks, and my business went to poop for a little while because things were rough.
Yeah.
And while everyone else was dollar cost averaging and buying the S&P at 650, 700, 800, I was just on the sidelines. And so I'll never do that again.
Yeah.
So I tend to be a little more conservative and it's different. But with that said, with my risk reward profile and my age, I don't want anyone, I'm more comfortable. I'd rather miss out on a little bit of upside than be there for the downside. When I look at the S&P chart, I see pretty good resistance at 6,500 on a monthly chart. Like that's a steep uptrend line that started about, I think it goes back to 2020, maybe earlier. Actually, I think it goes back to 2018 high. Anyway, 6,500 is pretty decent resistance. We're going into a seasonally weak period. I believe the US dollar is bottoming. That'll probably put pressure on stocks. The stock market often reverses course temporarily, not forever, of course.
Mhm.
When we go into earnings season, either at a high or a low, we usually come out the other end in the other direction. So with all of these things adding up, I'd rather be earning a few percentage points than having risk on the table. But
Yeah.
we'll just have to see how it unfolds.
Well, I mean, that makes a whole lot of sense. I mean, that's what we read in terms of like how you're supposed to be financially positioned to be prudent. You don't want to have your business correlated with the market. So you want to, so when the market's doing really, really well, and if your business is completely correlated, then you want to be a little bit more
Right.
conservative. Probably similar for people that are in big tech, right? So if big tech is
I
going
would,
straight up, you probably
yeah,
want to be a little bit more conservative if that's where all your money is,
yeah.
because at some
I
point
would
it's going to
suggest,
come down,
yeah,
right?
exactly. I would say that is what they should be doing. But the reality is, I mean, this market hasn't triggered too much pain for too many people over the last few years. So, sometimes people have to learn that lesson the hard way. And I learned pretty hard during the financial crisis, and I haven't really forgotten that. It's probably hurt me a little bit because I'm a little too conservative sometimes. But I don't ever want to feel what I felt like in 2006 through 2010 or 11.
Yeah, well, 100%. I think the challenge sometimes is we have to educate those newer investors that
Yeah,
didn't really feel that. They don't have that memory.
right.
And so for them, it's just the pandemic was a little blip, and
Yeah,
a couple months, it was literally a recession and drawdown that lasted a few months, and then like, hey,
I know.
it's buy the dip and forget about it.
It's worked for them. I mean, hey, what can I say? But there will be a time where, and I think it might be sooner than rather than later, where we have
Yeah,
a decade of just nothing. That's how this market's kind of been. If you remember from the 99 high through basically 2010, 2011, it was just a wash, nothing.
yeah.
So, and
Well,
that'll happen again someday.
yeah, I know. I started in the late '90s, so it's
Yeah,
still fairly fresh in
right.
my mind, like just how you go through these cycles.
Yeah.
But but there are some things I will say that change. And you go through these periods like the dot-com period where you had all those companies that weren't making any money, but then the internet did, turn out to be something pretty big. And then now you've got AI and a lot of interesting things going there. And some companies are making a lot of money from it.
Mhm.
So I don't know what your thoughts are on
Um,
all that's happening with AI.
Well, I mean, as a small business owner, I can say it's helped me out here and there. Has it saved me a handful of hours a week? Absolutely. Has it completely changed my business? Not yet. Maybe
Not
it will. I
yet.
don't know. I know
Yeah.
other businesses are going to have different stories. My big picture thought is a lot like how the internet was, the .com bubble in '99. It's definitely revolutionary, but whether the exact same ticker symbols that are benefiting now are the ones that come out
Yeah.
10, 20 years from now, I maybe, but I doubt it. Like, pets.com didn't fare so well, but guess what? Chewy.com is just kicking butt, right? So I think we might see those sorts of things. And I think it might be one of those hard washout cycles to get the reality of it. But I can't see the future. I can only see the past, and based on that, that's what I think is probably most likely.
Interesting. So, Carly, I want to ask you a little bit about just kind of, what's happening with the energy markets, with natural gas and oil and demand. There's all that happens, geopolitically, and then there's supply demand, and then there's the demand for, data centers. What do you think? I mean, when you look at the charts, do you ever look at the charts and say this chart's not factoring in everything? It's the people that are kind of making the chart happen, the
Mhm.
markets. But how do you view that, and what's kind of outlook for energy and everything that kind of
Right.
plugs into that?
So I actually think there's kind of two stories. Natural gas and crude oil are going to have two completely different scenarios in my mind. And a couple of reasons for that. For starters, for whatever reason, speculators like we in the world of commodities, we have a report. It's called the Commitment of Traders Report. It's actually issued by the government, and we can see what type of trader is long, or I'm sorry, small traders, large traders, or hedgers are long or short. And we can kind of guess, if that means anything, and if it does, what it might mean.
Sure.
And so with that said, speculators in crude oil are almost always long. They're perpetually long, waiting for that big explosion higher. But natural gas speculators are the exact opposite. They're always short.
Mm-hmm.
So I think natural gas, like at this juncture, the front month's trading under 3. And I think we probably have another 10 to 20 cents on the downside, believe it or not, just because this has been kind of a mild summer. Not using it as much as the market expected. But I think the market's underestimating LNG exports. I think we're maybe underestimating power demand going forward.
Oh,
so I think the natural gas is probably setting up for a really good buy. We're kind of stocking it. Seasonality turns bullish in a handful of weeks, and so we're hoping to get it a little bit lower. But I'd like to play the upside there. In crude oil, we've been in crude oil. I think is doing the opposite. I think the market's pricing in all the bombs dropping in the Middle East a few months ago, and all of those sorts of things are probably putting in a $10 or $15 premium onto the price that most likely isn't sustainable unless the violence continues and the supply disruptions continue to get into the headlines. Now, when I say supply disruptions, I'm just talking about the news. There's actually been 0 barrels of oil taken off the market with all of the stuff going on in the last few months.
Oh,
it's a well-supplied market. OPEC has actually increased their supply targets. Now, you can't always trust OPEC, but the idea is there doesn't seem to be a shortage of oil, even though the market it's not pricing in a shortage, but we were trading in the low 50s before things riled up in the Middle East. We got into almost to 80. I think the front month might have printed 82. And now we're on our way back down. So we've been in a sell the rallies mode in crude oil. We're in a buy the dips mode in natural gas. So 2 completely opposite scenarios. I will throw out a number in oil. And I think oil's probably looking for somewhere around $50 at minimum on the downside, and maybe even $40. Yeah. Oil's been trading below 65 the last couple of days. It's the weekly close last week was below 65. And this is really important. If you look at a monthly chart of oil, every time it gets below 65, it just gets heavier and heavier and then eventually falls off the cliff. We've seen it. We saw it during the financial crisis. We saw it in 2016. We saw it in 2020. And now right now we're kind of toying with under 65. And the longer it stays here, the more propensity it's going to have to slide quite a bit lower. So
how much of that, Carley, do you think is related to just like slowing economy? The consumers aren't traveling as much, and I sometimes look at that, and I also think that when oil prices are too high, it's almost a tax. It can be a little bit discouraging. So I'm in California. By the way, the gas prices are still really, really high here.
They are.
And I hear about, my co-host Tally, he couldn't make it today, but he's in New Jersey. And so it's like $2 something. So you have that. But do you think that, does that dynamic actually work with the oil where people say, well, I'm not going to travel as much. Prices are high. And then that's kind of the cure to make prices come down.
Yeah, high prices always cure high prices, and that's just always been true with commodities. And I think it's definitely true with oil. I do think that the thing is, this has been an odd cycle. Again, I'm going to go back to the same excuse. Maybe it's something different, but the way I see it is the pandemic stimulus is, it created all this pent up demand for travel and all these things. And I think people are starting to realize, okay, we burned through that money. We burned through our credit cards. Now maybe time to hit the brakes on this. I live in Vegas. It's obviously a very touristy city, and we tend to boom and bust, and we tend to see things quicker than the economy in general, because, if people have extra money, they come to Vegas. If they don't have extra money, they don't come to Vegas. It's really pretty simple. And we've really slowed down quite a bit. I have friends and family coming in, flying in. The planes aren't as full as they used to be. In fact, some of them are almost half empty. And that's really not something you normally see coming into Vegas. And this is on top of since the pandemic, they've cut the number of flights coming in pretty dramatically. So we're talking just a lot less people
Mm,
coming this year than have come in previous years. The strip is still pretty busy, but it's not as busy. So I can, you know, maybe this is just a temporary lull. Maybe there's something else going
yeah.
on, but it does feel like there's some slowing going on underneath the surface.
Well, and then if you do get resolution with Russia, Ukraine, then that would probably bring prices down more too, right?
It
Or
would.
just more stabilization, then yeah, you could probably see it maybe go even below
Yeah,
50.
that'd probably be good. I would say, I mean, Russian oil is still mostly making it onto the market, but
Yeah.
it's a lot less convenient, and there's all kinds of things going
Hmm.
on in the black market. But if we did get a resolution, it just kind of cleans things up quite a bit, opens up the markets quite a bit. And I mean, I don't know. I can't see the future. Don't have a crystal ball.
Yeah.
But I would speculate to say that we would be close to $40 if
Oh,
that did
wow.
occur. Yeah,
Wow.
it'd be pretty
That's
quick, I think.
that's interesting. How about like things like gold and Bitcoin? I mean, I feel it's odd that both of them would do so well, and they're not always correlated, but I feel like if you just look at the last few years, they've both done well. And I don't know if that's just people looking at like, they're not happy with deficit spending or the dollar
Mhm.
and how much of that, comes from other central banks for sure. With gold, it does. But what do you think about those two?
Um, so I'll start with gold. I have a more informed opinion there. I'm of the opinion that the gold rally is on its last leg. I think we're in the ninth inning. And maybe even Friday was like the nail in the coffin where we had that news on tariffs, and then that was kind of retracted and the market sold off quickly.
Oh,
Um, there's a lot of reasons I think gold's probably seen its best days for now on this move, but I'll start with the primary factor. I think is the U.S. dollar got thrown out with the bathwater in
hmm,
April. It was political, it was all kinds of things, but if you stop and look at the math, it doesn't make sense because interest rates in the U.S. are higher than anywhere else. The U.S. economy's, we've talked about maybe it's weakening, but it's still probably better than everywhere else. So there's not a real good fundamental reason um, to avoid the dollar. And I think a lot of that money that repatriated and sold the dollar and went home, I think that it might start working its way back into the market. If you look at Trump 1.0, the US dollar index today is following the exact same pattern that it did
mm,
during Trump 1.0, like almost to a T. It's a little quicker this
really?
time around. Yeah, it's quicker, but it's the same pattern. Like we popped up against a trend line. It looked like a breakout, and it ended up being a false breakout. We sold off 15 points and then recovered. So if we're following that pattern and we continue to, we should see the dollar basically get back up to where it was in February and January,
Yeah,
somewhere 108, 110. And I know nobody's expecting that to happen, but I'm just going off what happened last time. And so
sure.
far, we're running through the same playbook. So we'll just have to go with it until it stops working. But if that's the case, just that alone, all else being equal, gold's probably going to be under 3,000.
Mm,
Because gold, if you look at statistics over the last 190 trading days, gold and the dollar have settled in the opposite direction about 93 to 95% of the time. So higher dollar is going to thwart the gold rally regardless of anything else going on.
interesting. Well, we've been kind of talking about that internally as well, that this dollar weakness, like, and it's been pretty fast, right? And whenever I see things drop that fast, I always kind of wonder, like, well, the pendulum is going to start swinging the other direction. There's mean reversion or whatever you want to call it. So we've been also saying, well, let's not just completely jump into international just because, they've had a little bit of a run here. But like, as you say, if the dollar comes back,
Yeah,
it's still probably best to just keep, the positioning with, domestic equities as opposed to jumping all in on
sure.
international stocks.
Agree.
Interesting. How about with crypto and everything that's going on with
Yeah. So
Bitcoin?
there's obviously a few years ago, and actually I went on Mad Money and talked about this. There was an idea that Bitcoin was the new gold and nobody wanted gold anymore. And you should only buy Bitcoin. And we've seen over the last 3 years or so, that's actually, we've kind of come to find out that both assets are doing just fine. They're
Yeah.
in competition with each
Wild.
other. They are, yeah. And I think, again, I think a lot of it's just money running through the economy that needs a place to go. I truly believe that's a lot of it. It's not all of
Hmm.
it, but it's a lot of it. Um, I don't listen to anything I have to say about Bitcoin. I really, honestly, probably the worst Bitcoin analyst on the planet. When I look at it, I see zero intrinsic value. I don't I like the technology. I appreciate that technology. But
Sure.
when I think, is Bitcoin going to be the one coin that survives and that's the one we use for transactions at some point? I don't know. I'm not sure. I'm not really convinced of that. But I will say that I have a different perspective on my side of the business because, as I mentioned, we're in the risk management business, and our risk managers really are very strict with their Bitcoin futures allocations. And what I mean by that is we have to have special permission for people to trade Bitcoin
Hmm.
futures. The margins are instead of charging like most commodities, you pay like a 10% margin to control a much larger asset. In Bitcoin, the risk managers are a lot less reluctant to do that.
Hmm.
Or a lot more reluctant, I should say, because they know if the market's closed on Friday for futures, they can come in Monday morning and that crypto can be worth zero. I'm not saying it's going to, but it
Yeah.
can. And there's really no way to manage risk in between. And so,
Mhm.
again, don't listen to my opinion on Bitcoin, but I will. I've never bought it. I don't own it. Probably will never own it, and I'm okay with that.
Interesting. So I feel like something like with futures and it was probably best to just own the cash, the spot price, and
Yeah, I would.
not even wade into futures. But and now there's options on it too, or there's
Yeah.
even buffered strategies that will use it. But I mean, we've looked at it, and we have like some of the models that we've built would have a very, very tiny amount, and it's more just because it's not perfectly correlated with equities. And
Different
so,
correlations. Yeah.
but like you have to manage the risk on that like very actively, because it will
Yeah.
literally take over the portfolio. And then you do have these big drawdowns, and so you don't want to take over, and then it goes back
Yeah.
down, drops 70-80%.
For sure. I mean, I can appreciate the fact that it's another asset and the correlation benefits. And I'm not an expert on cash market crypto and all that kind of stuff. But what I can also say is there are a lot of things that happen at crypto brokerages that are illegal. Like we would literally be shut down as a futures brokerage if we operated the way they do.
Oh, wow.
So there's this is my opinion. I believe there's some integrity risk in the way that the business operates and the transactions are done. For example, I don't know if they still do this, but I talked to someone that was trading crypto a while back, and he was telling me that you can pay for better bids and asks, and there's all things that would shut us down go on there. And lastly, I'll say I do get phone calls occasionally, people wanting to buy Bitcoin. Then I explain to them how it works in the futures markets, and then they ask me, can I fund my account with a credit card? And I have to tell them, no, you can't do that in the futures market,
no.
but they can do it. They can do it at crypto brokerages.
Oh, wow.
So, just my take, but I think funding a crypto account on credit card is a very bad idea. And if there's a lot of people doing that, I'm a little bit worried, to be honest.
Well, and this is like I mentioned, before it started, the goal for the podcast is to educate people and to let them know, what is prudent, what's not prudent. And I'm happy to see that you're so focused on risk management. I know there's some folks that will look at momentum and different things, and I love momentum because I'm a CMT, but I'm also CFA. And I think that, some people think that, you just want to take the risk, and like some cases you do, but you have to have a process to manage that. And that's prudent. So that's super interesting what you're saying about it. Well, I mean, this has been fantastic. I guess the other questions I have for you is just kind of, your take on like poly markets. You're there in Vegas, and so poly markets, Fed fund futures. I don't know if you actually invest in things like that. I just see these things move wildly
Right.
up and down. Or do you just stick to, the normal, commodities and currencies? What do you think?
So I watch the poly markets just for interest purposes.
Yeah.
I don't ever participate in them, but I think they're definitely interesting. And I do agree that somebody that's actually putting their money where their mouth is probably a much better poll than, just answering a phone call. So I think I have interest in them, but I don't touch them. As far as like Fed fund futures, that's interesting. There's been a time in the past where we tried to dabble in Fed fund futures, but it's kind of a complicated market. Some people assume that whatever's going on in the Fed fund futures is going to somehow predict what's going to happen with the Fed, how the Fed behaves. And I think that in some ways it does influence the Fed at certain points in time. We've seen that.
Hmm.
But the reality is anybody that's participating in Fed fund futures are just like us. We're guessing, we're
Yeah.
speculating. We think we know what's going to happen, but we truly have no idea what's going to happen. So I haven't found it to be any more useful than any other tool as far as trying to predict what the Fed might do or might not do. So that's that. So we don't really trade it often. We do trade a lot of Treasury futures. So 10-year note futures, a strategy that we like a lot, is to go long futures and then buy a put option underneath, because the puts are really cheap in this market.
Oh,
And the contract size is at 100,000 par. So for literally a risk and margin of like, margin of like eight or 900, but a risk of like 1,500, you can basically control $100,000 worth of treasuries. So it's a pretty good deal in today's market. Now, a few years ago when the market was just, cascading lower, that was
yeah.
was a little different. But in this environment, it's a nice place to speculate, especially for beginning traders that are just learning different strategies. It's a good place to be.
Interesting. When you talk about like treasuries, I mean, what do you think about like we've tried to avoid, we took some risk off the table as it relates to longer dated treasuries because it just didn't feel like there was much of a bid there.
Yeah.
I mean, when you look at like 10-year, 20-year, 30-year, what are you seeing? Do you see, because you mentioned a while ago that like there was this kind of like not much risk appetite for dollar denominated assets. Do we get money coming back in there, or is that more structural?
So let me just say this. So I mentioned the COT report earlier in this podcast. And if you look at the COT report, speculators are holding one of the largest net short positions in treasuries ever. Now, the only time it's been larger was here in this last cycle. Handful of months ago, it was larger, and they've kind of unwound some of it. But if you look historically, even at today's levels, which are off the all-time low or all-time highs for net shorts, we're still literally dwarfing any other time in history for net shorts and treasuries. So we've been expecting this to unwind itself. It really hasn't yet. I mean, in April, we got a little bit of an unwind and it rallied and then came right back. And we all know what happened there. Kind of a failed rally. But we're of the opinion that at some point when it does break out of this range, it breaks out to the upside, for one, because I think most portfolios are under allocated to treasuries. And again, everyone in the futures, not everyone, but most speculators that are participating are short futures, not long.
Oh.
And so at some point, some people are going to say, you know what, maybe this is the wrong idea. Exactly like what we saw, when treasuries in 2020, when treasuries were dramatically higher and yields were lower. What was popular then was actually the worst thing you could have done. And I think what's unpopular now might be the better decision.
Oh,
but
interesting.
Yeah.
That's interesting. Well, this has been hugely helpful. We appreciate your time.
Thank you.
I guess final question, like what are the areas that you are most excited about? I get the areas that you're kind of concerned about, but like, what do you think is most interesting, both in the short term and long term?
So we're seeing, I don't know if any of your listeners follow the ag markets, but the ag markets have been going through some really interesting times.
Oh, interesting.
Cattle, livestock, beef prices are at astronomical prices.
Yeah.
Not just all-time high prices, but just off the charts, crazy stuff. And meanwhile, on the other end of the coin, we have corn, soybeans, and wheat at historical lows. And usually when actually, we've never seen the spread between those two assets this wide. And the reason
Wow.
the spread matters is a lot of farmers and ranchers use corn, soybeans, and wheat to feed their
Yeah.
cattle and vice versa. So it's just kind of an unnatural
Hmm.
um, thing going on. And I think sooner rather than later, we're going to see all of that unwind itself, which would mean cattle much lower, grains much higher. That's how we're positioned. It's been a really rough, kind of a rocky ride, but in the big picture, I think that's the overall idea. So
Interesting. Well, and I guess the final question here. Sorry, but things like cocoa, we've seen huge
yeah.
increases, and then copper. How much is copper like? How much is that manipulated by just the Chinese and what they're doing there versus like actual demand for global
Um,
demand?
so cocoa and even coffee have kind of gone through like boom cycles to all-time highs here in the last couple of years. Those are kind of unique markets because they're grown in different like third world countries mostly.
Hmm.
So the data on those markets is sketchy. In
Oh,
my opinion, there's a lot of manipulation of headlines and data, and so it's really hard to get a good read of what's
interesting.
really going on. So they get really, really messy and they get out of control, I think is what we've seen. But I expect both of those markets eventually to work their way lower. High prices
Yeah.
always cure high prices. And we've
Yeah.
seen some of that. I mean, coffee right now is trading in the low threes. It dipped into the high twos and it started at 420 coming into the year.
Hmm.
So we've seen some really, really wild stuff over there. As far as copper goes, copper is known as a bellwether for the economy, and I think it's pretty telling to see that copper has sold off so sharply here in the last couple of weeks. For
Yeah.
full disclosure, we had been playing the downside in copper. Like we see copper as a sell the rallies market, very similar to gold.
Hmm.
Not only because we kind of expect a little bit of weakness in the economy, but because we think the dollar will get stronger and that's going to push copper down.
Oh, yeah. Yeah.
But for to be 100% honest, we were short copper when Trump announced that 50% tariff. We had an option spread on, and we went from being profitable like $1,200 roughly. I'm kind of rounding.
Yeah.
30 seconds later, we were down 12,000. So it was one of
Oh,
those kinds of things
wow.
where it just gets out of control. But luckily, we hedged it. We wrote it out. We manipulated some stuff. We ended up getting close to scratch. I think it ended up being a small loss when we
Yeah.
unwound it because literally 2 weeks later, he said, "Oh, never mind. We're not going to do that." The market came back down. So it's commodities have been really, really tough. I would say if for somebody that's interested in getting involved in this environment, the only strategy that I can suggest to people is the sidelines as a position. Eventually, the administration or something politically is going to happen. It's going to push things out of bounds, and then you're going to have some really good opportunities to
Hmm.
play it. But it's really tough. You're already in the market, and something is announced that was unexpected. It's really tough to play catch up with that.
Hers and his, three's company too. Come and dance on our floor. Take a step that is new.